Welcome to the PRISM Planning and Solutions Group video library. PRISM's mission is to empower you to pursue your dreams and passions while ensuring you feel well cared for, informed, and secure. The following is a recording of a live invitation-only presentation. If you would like to be added to the invitation list, please email info@ppsgrp.com. PRISM Planning and Solutions Group is a DBA of Insight Advisors, a registered investment advisor. Advisory services are only offered to clients or prospective clients where Insight Advisors and its representatives are properly licensed or exempt from licensure. This material is solely for informational purposes. Past performance is no guarantee of future results. Investing involves risk and possible loss of principal capital. No advice may be rendered by Insight Advisors unless a client service agreement is in place. This presentation may discuss different ideas and strategies, but none of the ideas shared should be interpreted as specific recommendations. We only provide advice to clients with whom we are engaged and for whom we have done a financial plan. If you'd like to learn more about working with us, feel free to visit our website at www.ppsgrp.com.
Tonight, we're going to be talking about a few things. First, as hopefully most of you know by now, congratulations are due to Brianna Skorvanik. In November, she passed her CFP certification exam on the first try, which is a big deal. Less than 60% of the people that take the exam pass it on the first try. So that's very significant. And given that she has 3 years of actually working in the financial planning world under my supervision as a certified financial planner, she is now eligible to be called a certified financial planner. So this is a big accomplishment. So congratulations to Brianna. We are going to be talking tonight about some updates on economics, right? Some of the key metrics. What are credit markets telling us? I'm going to go through some of the things in the equity markets. A very brief history lesson, particularly by my standards, as you know. I've only got 2 slides for that. Talking a little bit about our philosophy and process and what to expect in 2024. So first, I'm going to start with some charts. I say thank you to JP Morgan Asset Management, who's provided the resource for this tonight. They've actually got some great slides for us to use. So we're going to see more of them. First, I want to talk about inflation. This has been the main topic of discussion for the last couple of years, right? Coming out of COVID, we know we saw a spike in inflation. You can see that over here, right? What we call headline inflation. And then components of that are core CPI. We take out food and energy. The PCE number, you heard me talk about that a lot, and I've shown you charts on that. Excuse me, that's the personal consumption expenditures. That's what the Fed watches more. That comes out every month. The December number came out at 2.9, which was less than expected. The expected number was 3.0. The reason the Fed watches the PCE number more closely than CPI is that PCE shows what people are actually spending money on, or how much money they're spending. Right, so you got those 2 pieces to it. CPI is a fixed basket of goods, and we see the change in the price of that basket of goods. But what most of us do is if the prices of certain goods go up by more than a certain amount, we change our behavior, right? If you're used to buying the 95% lean ground beef, and the price of that goes from, $5.99 a pound to $10.99 a pound, you might step back to the 85% because you can get that for $7.99. That type of substitution behavior is captured in the PCE numbers. It is not captured in the inflation numbers. That's why we look at both. All right, what you can see here is that both CPI and core CPI have come back down, right, below this 50-year average. You can see here the 50-year average of headline CPI is 3.9%. It came in December at 3.3. So we don't see the Fed saying it's licked inflation. That's a good thing. We don't want it to say that. They do have a long-term target of getting it back down closer to 2%. We had all these years in here where it ran well below 2%. Excuse me. Sorry, I'm a bit dry tonight. It's going to take a while to get us all the way back to 2. Personally, I don't think we need to get there. I would like to see, as we get into late 2024, early 2025, the Fed acknowledge that they're willing to run about 2.5%, as long as all the other numbers are showing that we are not looking at pressures that are going to force them to have to raise rates. So, important story here is, yes, we had a spike in inflation. We've come back down. We're back at a normal range. Okay. We also look at interest rates and inflation. And again, we're looking at long-term averages. This number is 1958 until now. This is all the way through January 31st. I pulled these numbers today. So nominal yield is the coupon rate. So when you look, when you see on the news, 10-year Treasury is paying, 4.2%, that's nominal yield. When you take into account inflation, when you subtract out inflation, you're getting the real yield. So since 1958, nominal yields have averaged about 5.75, with inflation at just under 3.7. Real yields have been a little bit over 2. Real yields right now are still close to 0. Okay, there's room for that to go up. That will go up as inflation comes down, but it also makes the point that we are not likely to see interest rates come down very much anytime soon. Right? So where we are now is much closer to historical averages as far as nominal yield. We're still below them. Okay. And until we see real yields coming back up to closer to 2%, I don't think the Fed is going to feel pressure to reduce rates, because they're still very low compared to historical numbers. Okay. Now, our economy is predominantly made up of consumer consumption, right? That's what this bar chart over here is showing you. So this is in the fourth quarter of 2023, right? 2/3 of it, 67.6% of all what is produced in this country, right, is coming from consumer spending. The long-term trend growth, you can see this blue dotted line right here, is 2%. We're never too far, except for this period in 2020, right? And we're not too far away from that. We did see it basically fall off a cliff when the economy came to a grinding halt in 2020, but we are back on trend. Okay, so things have healed is the best way to put that. And keep in mind, when we talk a little bit later, it is the consumer that drives the U.S. economy, right? We'll talk about some other aspects of the U.S. consumer in a couple of minutes. Unemployment and wages. Again, this is related to how are consumers feeling? What is consumer behavior likely to be? What we have seen recently is wage growth that is much higher than we have seen in decades. So this blue line is showing you wage growth, and the historical average over 50 years is right here at this line on the bottom part of the graph at 3.9%. You can see from 2009 to 2019, it was below that line, and at some point, well below that line, right? Well below 2%. We barely got to that line, right? And for a couple of years in the middle of the first decade of the century. Again, before that, the previous 10 years, well below it. And even going back, we don't see any kind of wage growth significantly above that long-term average unless we go back to the 1980s. Okay, and it began declining then. Look at what happens, though, in 2021. We've seen a spike. You've heard me talk before about these long-term trends, 40-year trends, 80-year trends. To me, this is a positive indication that we are beginning to see the pivot towards the next 10 years having more power going to labor, right? You've heard me talk about the fact that there have been more labor strikes last year. People today have a much lower level of purchasing power, right? Their real income. When you look at what things cost relative to how much they're working and how much they're earning, their standard of living is much lower today than it was 20 or 30 years ago. We have seen these cycles before in this country, okay? But we appear to be at the beginning of the trend to see that change. And these numbers indicate that. These numbers are related to the big spikes here in unemployment, right? Almost 15% unemployment was 2020. We have low unemployment, right? Which means not a lot of people out there looking for jobs, in theory, according to the statistics. Those that are have a little more leverage in wages, right? And asking for higher salaries. Now, there are a lot of numbers behind the numbers with unemployment. There's a lot of debate about the quality of people's employment. So the fact that people are employed doesn't mean they're what we would consider fully employed. But the important metric here is that even though we have seen interest rates go from 0% to 5% over the last 18 months, which is we've raised the price of money, which was specifically designed to slow down demand, to put pressure on corporate profits, that in previous cycles, right, has led to a significant increase in the unemployment rate. We haven't seen that. There is something in an economy called the natural rate of unemployment. There's always a certain number of people changing jobs, right? So a snapshot captures a lot of that. When I was in school, they thought the natural rate of unemployment was between 5 and 6%. Okay, there are some that think we may see the unemployment rate in the second half of this year and the first half of 2025 get close to 5%. I'm not convinced of that. And I'm not sure that we have to get that high to feel like we don't have pressure in the labor market. But these things, the important things is that these things are all positive for the economy overall. It indicates there's a strength in the economy. The economy has healed from the 2008 financial crisis, the housing crisis. You've heard me talk about history, that it takes between 8 and 12 years for an economy to heal itself after a major crisis driven by credit, right? Too much debt. We kept rates at 0% for an entire decade. I mean, keep oil pumping in that leaky engine until the economy healed itself. This is evidence that it has. The economy still continues to be strong. It has absorbed these interest rate increases, right? We are seeing reasonable levels of wage growth, right around historical averages after this initial spike. And we are seeing unemployment well below historical averages. These are all positive signs for the economy. Now, long-term, what are the drivers of economic growth? A lot of information on this chart. In this table in the upper left-hand corner, what you're looking at is the growth in the working age population in this country. Now, why does that matter? Well, we are getting older. We are seeing that once people get to age 65, their life expectancy is about 10 years longer than it was when they were born. Right? You've heard me talk about this before. There's a bunch of stuff that can get you before you're 65. But if you live and you get past those things, the longer you live, the longer you're expected to live. Our Social Security system, right, which was started almost 100 years ago, is based upon a ratio of people who are working to people who are retired and collecting. That ratio has been shrinking for several decades, right? When it was first put in place, a much smaller percentage of the population ever reached 65. And those that did were only expected to live a handful of years. So the fact that we now have a much larger number of people reaching 65 and they're living much longer has created stress. We need more people of working age population to help keep the system going. In 1980 to 1989, right, we had a total growth on average on an annual basis of over 1%. 80% of those people were US born, 30% were immigrants to this country. In the 90s, still over 1% growth in the working age population, a more evenly split between native born and immigrant. More growth in the labor pool in the first decade of this century. Again, almost half of it coming from immigration, but look at what's happened since 2010. This is one of the things that concerns economists about our economy over the next 10 or 20 years. If we do not have an increase in our working age population, we are going to have too many people retired relative to the number of people we have working. This is one of the reasons we have to solve the immigration issue, right? Regardless of how you feel politically about the various solutions that have been proposed, if we don't solve this, we are going to face what economies like Japan face, which is an aging, and China. I think Japan is down to the average woman of childbearing age is having 1.2 children per year. It takes about 2.1 births per year to sustain an economy, to sustain a population. When your growth rate falls below that, right, you end up with what could in essence be a dying economy. So the projections about the growth rate in the working age population is probably one of the biggest areas of concern. Now, it's offset by a couple of other things. Over here, you can see that the growth in GDP is driven by a combination of the growth in number of workers and the growth in the output per worker, the productivity. We've seen the overall GDP growth rate decline. Right, again, this goes back to the 1950s, the 60s, the 70s, the 80s, the 90s, right? And now this is the 21st century. So our GDP growth is half what it was in the 50s and 60s, okay? But we are getting much higher productivity out of each worker. So these numbers showing the decline in working age population are one side of the story. The fact that productivity increases are so relatively high, right? So of 2% GDP growth since 2020, most 3/4 of it is coming from productivity. That is a buffer against a decline in the growth rate of working age population. It is probably not something that's going to keep us from having challenges in the future. But the flip side, some people have talked about a loss of jobs from technology. AI is going to take all the jobs. Well, if the number of working age people in the country is not growing at a fast enough rate, okay, or if it's growing too slowly, depending on how we say that sentence, it will actually reduce the number of people who are put out of work by technology. It's kind of a backwards thing. We can talk more about that if you're interested. The chart over here on the lower left-hand corner is showing that there was a crossover point about 1992. Okay, the green line in the middle is showing companies spending on structures, right? Manufacturing plants. The blue line is investment in intellectual property and R&D. So we talk about going from an industrial economy to a service economy, right? In the late 1800s, you went from an agricultural society to an industrial society in the early part of the 20th century. We began a transition in the 1990s, well, we really started before that, 1980s, to move from an industrial economy to a service economy. And you can see the crossover here in terms of capital and investment. And that trend continues. Companies are now putting more money into intellectual property and research and development than they're putting either into structures or equipment. Okay, that's what's driving this productivity number, right? So this is what's going on underneath the surface. If this continues, right, this will help protect us from the impact of a decline in the growth of working age population. So this is why this number is watched so carefully. Now, looking at what's going on in the fixed income markets, what are they telling us? I've often said that fixed income markets can telegraph potential problems in the economy and the stock markets well in advance if you know how to speak the language. I have not yet become fluent in bond markets, but there are a couple of key things that I look at. Remember, we talked about a rise in interest rates, the idea of refinancing debt. One of the things that happened in the decade of 0% interest rates is every company restructured its balance sheets to take advantage of low interest rates, including companies that are not of the best quality, what we call high yield. We used to call them junk, but non-investment grade. One of the concerns in the market, right, in general, in the economy, is what's going to happen when all of those companies that are lower rated companies that refinance debt, like basically are able to borrow for next to nothing, have to come back and refinance that debt at much higher interest rates. What kind of pressure is that going to put on the system? And it can put pressure on the system. So this slide is looking at some of the ways that we assess when that could happen and what the magnitude of that pressure could look like. So this chart on the left is showing the maturity schedule, right? So the black bar here is investment grade, the blue is the high yield. What you can see is we have a few years until this becomes a huge issue, right? So when you look at an overall bond index, this is breaking down what percentage of the bonds in the index, right, either investment grade or high yield, are coming due in any year. So in 2024, less than 3% of the high yield debt out there is coming up for refinance. In 2025, it's a little bit over 6%. Okay, when we get out towards 27, 28, it's going to be a bigger issue. Now, everybody's expectation is that actual real interest rates will be down a bit by then. There are a couple of components to interest rates, quantitative tightening, which I think has tightened up monetary policy, not on the headline, but in the reality. That will be easing and things like that. But so this is the time period that we want to start looking at, right? And be thinking about and watch the economic indicators as we get towards that point. We know we've had what we would call zombie companies, right? Companies that should have gone out of business, that were able to stay in business because they could borrow money for next to nothing to keep the doors open. There will be a natural fall off in that. There should be. This schedule suggests that it is not going to be around the corner. It's not going to be tomorrow. It's not going to be 2024. And there's going to be plenty of advance warning. So the market will be able to adjust, and it is unlikely to become a shock to the system, right? Shocks to the system are the problem. Things that we can see coming a mile away, we can adjust for, we can adapt, we can plan for. It's the shocks we have to worry about. And this is suggesting we're not going to be dealing with a shock. On the upper right-hand corner here, what we're looking at is in the bond indices, right? The quality inside the high yield index. So high yield refers to anything below investment grade. Triple B is the lowest level of investment grade, right? You get double B, single B, then you go into the C's. What's different today versus 2007? So in 2007, right, this dark black line here showed that this black line here was showing that about 8% of the overall bond index, right, the high yield bond index was triple B, right? But about 1.5% of it is today. Double B, again, we have a much larger percentage that are higher quality. That's really the short version here. So if you go down to this triple C, which is the lower rated or no rating at all, there was a larger percentage of the index was at this lower rating in 2007 than today. Next level up is single B. Again, there were more bonds in that segment of the index in 2007 than there are today. This is another reason that we don't think there's going to be a shock of defaults that are unexpected, because the overall quality inside the high yield index is significantly better than it was in 2007, which is going into the crisis of 2008. The default rate is the third component. So what you can see down here is these three clients, this group, the double B, the single B, and the triple C, and then high yield overall, the 25-year average of what percentage of the bonds in that category end up defaulting on their debt. Overall, the average is about 3%, right? That means 97% pay. One of the things that happened in January of 2009, this market was pricing as if 25% of these bonds were going to default. Now, everybody understood that it wasn't going to get to 25%, but nobody felt confident in predicting who the survivors were going to be. So that led to assuming a much higher level of risk. Right? When we look at the averages, the last 12 months, we've seen on average only 2% of high yield bonds defaulting. So we're still 30% below the long-term average. Okay. More importantly, we've seen no defaults at all in the double Bs. We've seen a very low rate of default in the single Bs. The defaults have been in the triple Cs. So you have two things combining to make this significantly better than the last cycle. You have a lower percentage, right, of the index itself being in the triple Cs, which is the lower end of the quality. And you have a much higher level of success of non-default in these higher quality within the high yield. So the double Bs and Bs are defaulting at a much lower rate than they have in previous cycles. And these categories are a much higher percentage of the index, right? So again, reasons that we are not terribly concerned. That's what the bond market is telling us, not to be terribly concerned. Again, that may change, but that's where we are now. What do we expect from the Fed? You've all heard about dot plots and so forth. What I wanted to point out here is that you have a couple of different indications here. The Open Market Committee is estimating, right? And this changes, right? So every 6 weeks, the Fed meets. Every Fed governor has its expectations of, what's going to happen this year and really over the next 3 years in the long run, where rates are going to be. And they're picking an exact number. Oh, I think it's going to be 3.25%. Yeah, but I think it's going to be 3.5%. You're trying to predict with that level of precision where rates are going to be 3 years. Interesting challenge. The market is expecting rates to come down faster than the Fed is telegraphing, right? And they're expecting it to get to this level down here a lot faster, but the Fed is projecting eventually they'll get lower than what the market is predicting. Now, I don't spend a lot of time on this because the market is reacting to very short-term data. A month ago, the market was pricing in better than 60% probability the Fed was going to cut in March, right? I've been saying to you for several months, it's not going to happen, right? Maybe second half of the year. At this point, I think maybe we're looking at June. But I think that the Fed wants to wait longer. It's the smart thing to do, right? They want to wait. There's room for them to wait. The market would like the Fed to cut sooner. So some of this is saying, hey, we're going to bet on a cut sooner, and then they'll back off when the data suggests it. Whereas the Fed is saying, we're going to wait to cut, but we'll change if the data suggests it. So there's a conflict here. Point is, we have seen the peak of interest rates for this cycle. I don't think there's anybody who disagrees with that. We are going to see a trend downward in rates over the next 2 to 3 years. I do not think that they are going to get down as low as the market thinks they're going to get or would like them to get. Okay, it's not healthy for the economy. And I think the Fed's projections of how low rates are going to get is too low, because what they're going to find is the real numbers in the economy don't support having rates go that low, and that's a good thing. Okay, so let's shift and talk about stock markets, equity markets. S&P 500, US large cap stocks. This chart is showing you at inflection points what happens in the next 12 months. I'm not focused on that here. What I wanted to show you is, number one, right, we've just come back and crossed over the previous high that we had reached in January of 22. So 2 years ago, right, we had a high in the market. We came down, we came up, we kind of thought we were going to get up here and beat this last fall. It didn't happen. We have just now, in the last week or so, right, crossed and made a new high in the market. That's positive. In and of itself, that's a positive sign, okay, because we've held it. What I wanted to point out here, these are metrics of valuations, because this is, 5,000 is a big number, right? But how do we know? Well, price earnings ratio, as you know, is one of the key metrics we use to assess, right? For every dollar of earnings, what are we paying? So back in 2000, March of 2000, just before the market collapse, dot-com bubble, the P/E ratio was 25. So if earnings were expected to be, $2, you were paying $50 for the stock. That's really expensive. In October of 2007, October 9th was like after the big collapse, it fell to 15. In February of 2020, just before COVID hit, we were at 19. We got, at the beginning of 2022, right, this previous high over here, we got up to 21.4. Today, we're at 19.8. Now, it's higher than the long-term average, but it is nowhere near where we were in the dot-com bubble. So I've made the same comparison. There are things going on inside the market that are very reminiscent of 1999, 2000, but valuation is nowhere near as much of an issue as it was then, which means that these companies, even though they're trading at relatively high valuations, they do have earnings. That's different, right? Back in 1999 and 2000, there were a bunch of companies that weren't making any money. They had no plans to make any money. They said you could go public with a company that said never going to make a dime.com, and people were throwing money at them. This is not happening this time round. So even though there are valuations that are stretched, the quality of them is better. This is looking specifically at the forward PE ratio and putting on top of it the 30-year average, right? This green line in the middle is a 30-year average of about 16.6. One standard deviation above that is 19.8. One standard deviation below that is 13.3. What you all know from all of our conversations about standard deviation is this means that 2/3 of the time, it's in between this top and bottom green line. We're right at that top line. Okay. Can we go higher on valuation? Yes, we were higher in January of 2022, which is partly why we saw 22 be such a bad year. Okay. I don't really want it to get much higher, right? If it gets much higher, we should really expect a pullback. But so this is one of the valuations that we watch. Now, what's interesting about the change in the interest rate world, right, that we now have yield in treasuries, is what happens between value stocks and growth stocks. There are a lot of different definitions to value and growth. For our purposes, value is the Russell 1000 value, and growth is the Russell 1000 growth. And that's a function of price earnings ratio. The way I'd like you to think about it is value businesses are companies that are a little bit more sensitive to the economic cycle. You want to look at them based upon cash flow. You want to look at them based on earnings multiples. They're not necessarily big innovative companies, right? They're not in a position, because of what they do, to grow at much faster rates in the economy because of I use an example of, say, Caterpillar, right? Caterpillar makes tractors and big moving equipment. There's not a lot new that they're going to come up with in tractors that's going to allow them to sell a lot more tractors if we're in a recession. right? And the big heavy equipment that they use. They are much more dependent upon what's going on in the economy. So what we look at is how well is the business being run? Are they well positioned that if the economy slows down, they have enough of a buffer, for example? And we're very concerned with their valuation. When we have zero interest rates, okay, growth has done much, much better because they're in a position with innovation to grow faster than average, and money is cheap. Money is free. Money's been free, right? With interest rates from 0 to 2 and 2 to 3%. So that growth has outperformed value is expected. But as we actually have money with a cost, right? So you actually tend to have value outperform growth. And that's one of the things, this goes back to 1979. So this is one of the things that we are looking for and expecting. We've had this period, right? This is one of the side effects, the unintended consequences of having money kept at 0% for 10 years, is that it allowed for this distortion in the prices of growth stocks, right? Now that we are going to have yields probably in this 4 to 5% range for a while to come, right? We expect that value will have its day. And again, this is just another chart of looking at that relationship. What are the things that concern me? You've heard me talk about this before, the concentration in the S&P 500. This is where it looks a lot like 1999, 2000. It also looks a lot like 1973 with the Nifty 50. So what we saw, this is in 2020, this is all through 2023. So the price earnings multiple of the top 10 stocks in the S&P 500 is over 29. And they generated 86% of the return of the S&P 500. Okay, the rest of the stocks had a PE of 18. Okay, but they only generated 14% of the return. So what that means is if you weren't in those big 10 stocks, you dramatically underperformed. Okay, so if you owned just those top 10 stocks, you were up 67% last year. If you own the index, right, you're up 26. If you owned the other 490 and didn't own those 10, you're only up 9. That is a level of dispersion, right? The difference between the top 10 and the other 490, that is a very extreme number. We have been here twice before. We were here in 2000 and we were here in 1973. Now, what's different about these cycles, right, is in 2000, we saw a lot of those companies experience tremendous financial hardship over the next 10 years, and some of them went out of business. 1973, that did not happen, but they did. But what was true is they were all out of the top 10 years later. That is what happens with these cycles. So this type of dispersion can continue for a certain amount of time. I was saying the same thing last year. Is this going to be the year where it all changes? I don't know, but I think from what we're seeing, the market is broadening out. You heard me talk last fall, I think, about looking for more breadth in the market. We started to see that in the last couple of months. We started to see what they call the S&P 493 of the Magnificent Seven and the other 493. We're starting to see a little more strength there. If you watch the Russell 2000 index, the small cap index, that's where you'll see some of the indication of it. The expectation is the second half of 2024, we should start to see the earnings of those other 490 companies start to see stronger growth in earnings than the top 10. Okay, so that will set things up as we go into late 2024, early 2025, for that segment of the index to do better, which is actually good for the overall market. Okay, so we're going to continue to see strength in the market. Again, these are earnings contributions, weight of the stocks in the index. Whoops, these are all just reinforcing some of this concern. Now, what you're seeing here, see in this lower right-hand corner, you're starting to see what I'm talking about. So the earnings contribution of the top 10 in the S&P 500 is starting to fall off. Okay. they're still comprising, right? The large part of the top 10 stocks are now 32.5% of the market cap of the S&P 500, but the earnings are beginning to fall. And so that's, again, this is the kind of stuff that we watch. Another thing that I'm looking at is US versus EFA, which is Europe. It's basically all the non-US developed markets, not including emerging markets. What we see is this is going back to 1971. You have periods of the black is when the US outperforms EFA, and the purple is when EFA outperforms the US. And what you can see is it climbs, it spikes, right? And then it turns. And then the other one takes over. It climbs, it spikes, it falls, right? So that's the pattern that keeps repeating. Now we're coming off the longest period going back to 1971 of US outperformance. And we've seen this spike here. Since the end of 2021, right, we've actually seen EFA begin to outperform the US. Okay, so doesn't feel that way. You certainly don't hear it on the news, but we're seeing this start. When we look at numbers, we look at performance numbers. The trick is to, when you look at long-term numbers, you can have had a great year 3 years ago, and that's still built into the numbers. And so what's happened in the last 6 months, and if the trend is beginning to change, it gets masked, right? So that's why we look at things like this. So all of this is speaking to ongoing strength, strong economy, more breadth in the market. We can keep going and seeing growth, but it's going to come from different places than it's come from in the last 10 years. This is the chart we always look at, right? This is slide 1 of our history. So we're coming to the end of this part. This is showing you, again, the different segments of the market, the asset class, and which is the best in any one year. And it's very hard to find a pattern. But the diversified portfolio, right, never at the top, but never at the bottom. And that's why we do this, okay? The biggest thing is time for you. If you want to talk about diversifying, remember we talk about time and cash. People talk about, well, this investment in correlation, and if I buy bonds, aren't they going to protect me with stock market volatility? Well, everybody saw in 2022 how badly that worked, right? Really, besides cash, time is your best protection against stock market volatility. What this is showing you is in the period from 1950 to 2023, stocks had an average return of just over 11%. Bonds had an average return of just right at 5.5%. Okay. These bars, and this is a 60-40 portfolio here that had an average return of just over 9%. But again, with the bond piece, let's just take that out of it. Let's just focus on stocks versus bonds. In any one year, going back to 1950, in order to get that 11% average return, you could be anywhere from up 47 to down 39% in any one year. Whereas in your bond portfolio, you might have been up 43 and down 13. So that's still for something that you expect to be safe, to have a 56% swing in best to worst return isn't very stable, okay? When you look at a 5-year period, and again, we talk about rolling periods. These are, we start January, we go out 60 months. We start February, we go out 60 months. We average them all together. All of a sudden, any 5-year period, the worst you did in stocks was being down 3%. But yeah, the worst you did in bonds was being down 2%. But you had up 28% on the upside versus 23%, right, in the bonds. And again, when you go 10 years and when you go 20 years, you've never had a negative 20-year period in stocks, and you've got a much higher average return over the period by being in stocks. What's the point? The point is, in the short term, stocks are much more volatile than bonds, number one. Bonds are volatile, so don't kid yourself. But this is why when we talk about investing, money that is invested needs to be for longer term, because if you leave it in there, you'll be fine. So that's also why we use cash. Okay, so those are the slides from JP Morgan. Okay, So let's talk a little bit now about what we're doing. You all know that the planning process is repetitive, right? It's iterative. What are you trying to accomplish? Where do you stand now? What will happen if you keep going? What are some of the changes we think you should make? And then most importantly, right, we help you develop the next steps and work with you to implement them. But as they evolve, we are here with you every step of the way. Life is going to throw curveballs. So as you achieve your milestones, right, we're going to help you update your goals and your plan and adjust to those curveballs. Our process, excuse me, of turning your portfolio into income starts first with this cash bucket. This is exactly why I was talking about the stock market volatility. Any money you know you need to spend in the next 2 to 3 years should not be at risk in the market. Period. End of story. Today, at least, you can earn 4 or 5% on it. Even when you could earn 0, we were saying the same thing, right? The bulk of the money that doesn't need to be spent in the next 4 years is invested to mitigate the risks of longevity and inflation. Our core investing philosophies that haven't changed and are not going to change. Quality businesses tend to perform well over time and are more resilient in times of stress. Free cash flow and dividends, particularly companies that are increasing their dividends year after year, can be effective ways to determine what's quality. Part of that has to do with companies that keep cash on their balance sheet versus companies that are carrying more debt, which means in times of stress, they have interest payments that need to be made, right? That puts pressure on the company. So free cash flow is a way of assessing how much of a buffer does a company have in times of economic stress. And I've said this before, time, cash, and diversification are critical aspects of your risk management, but time and cash come first, right? In times of market stress, all correlations go to 1. So if you don't have time on your side and you don't have cash to ride it out, you could be forced to sell and create permanent impairment of capital. Okay. 3 general rules. Don't fight the Fed, don't fight the trend, beware the crowded extremes. Once everybody knows something, it doesn't work anymore. Okay. So what do we expect in 2024? We are making some changes in the portfolio. The story is still the same. Global exposure, and then adding in disruption as a theme, right? Companies that are investing in disrupting their industries, and an emphasis on companies that are generating free cash flow. I have not used bonds in portfolios going back to 2017. We actually are going to start to see a change in that in some of our accounts. The foundation for most of our accounts are going to come from wisdom tree strategic allocation models. I can talk more about why I've been using them for years. You've seen our ETFs, their ETFs in the portfolios. I'm leaning more heavily because they're good and they're successful at this, at their overall asset allocation models. And because I am now comfortable adding in some bond allocations, they're a very effective way to do it, right? And then we have our free cash flow model, and we have the disruptive growth model as well. So this is allowing us to add some nuance, right? And we're going to be talking with all of you about this through the coming year. We're actually going to be breaking out different allocations on the long-term portion of your portfolio based on your situation, your preferences. I'm going back to asking the 80-20 question for any of you who've been with me for a while. All right, you're going to see that question come back as well. We've done your data points profiles. So when we get down into these portfolios down here, right, we're going to disruptive growth starts to get added in when we get into the growth model, right? And the aggressive growth is going to have less focus on free cash flow, more focus on disruptive growth. So just to wrap up, economic and market looks good. right? We're expecting more normal interest rates to allow the market to widen out in terms of earnings growth. Our planning process is still at the heart of everything that we do with you. Our philosophies are going to continue to be focused on the same things they've been focused on for years, right? The bias towards dividend paying companies. We're going to have growth. We're going to focus on free cash flow. We know this transition to Schwab has been very painful and very disappointing for many of you. We have a solution. We appreciate your continued confidence in the entire PRISM team. And with that, thank you for joining us. For more information, please go to our website, www.ppsgrp.com.